What's up YouTube? This is The Working Investor. In today's video I'm going to show you how you can make 2%, 4% or even 8% of profit per month. Today I'm going to show you how I'm doing my triple leverage margin TQQ option high risk play. What I've done here is that I bought a long call of TQQQ at a strike price of $18, which expires January 19th, 2024, which is the furthest out expiration date that I was able to find. I paid $25 a share, or $2,500 for one contract, which is 100 shares. So that's what I'm risking on the line right now to lose. The strike price of TQQ at the point was $39. The delta was approximately 0.895. The cost basis was $18 per share that I've had my strike price for, plus $25 per share, which I'm paying out. So my total cost basis is $43. My max profit is infinite. My max loss is $2,500. On the right, you'll see that I sold against my position a call for TQQQ with a strike price of $44 per share, expiring about a month out, 9/16/2022. I received a premium of $100 straight up front. TQQQ at the time was trading around $38 per share. The delta was currently 0.21. My new cost basis was $43, which was my original cost basis, minus $1 per share, which I've just received in premium, which equates to $42 is my new cost basis. My max profit is $200 because, if my cost basis is 42 and it goes up to 44, which is the strike price, I'll just walk away with $200 total, $100 now, $100 in growth, which will equate to around 8% return in 30 days. If you analyze that, that's about 96% a year, and that's only if it's going up. If it goes down, which it is, I would just keep the $100, which would be 4% profit in a month, and then I would just keep selling more calls. So now you can see my max loss was just reduced from $2,500 to $2,400 because I received $100 credit. So going on over here, so mitigating the risks. What happens if TQQ goes down, or what happens if it goes above the short position? So if it goes down, one of the options I could do is buy another TQQQ long call at a much lower price, a dollar cost average, let's say at $10. Or I could roll the position out further when a new position becomes available. Again, one of the ways of limiting the risk is to mitigating the risk is to limit my TQQQ gamble to only 10% or less of account value. So if this goes belly up, my entire account is not just burnt up. I'm willing to keep dollar cost averaging into TQQQ as well. If TQQ goes beyond the short price, I can just do nothing and enjoy the sweet 8% return. 8% return in 30 days is not that bad, or $200 in 30 days on a $2,500 gamble is not too bad. Or I can just roll the short position up and out, which I've done in the past, but I actually have regretted doing that in the past. Why TQQQ? I'm very bullish on the tech sector, and I feel like we're going into a point where we could finally get some great prices on tech. And with TQQQ, a triple leverage tech, if tech goes up eventually, you're going to get triple return when it goes up. So I'm really, really bullish, and I enjoy this ETF. That's just my personal risk tolerance. But again, even on its own website, it says this is not intended to be like a long-term hold more than one day, because you lose a lot of money from expense ratios, and it gets very complicated with the math. So I would rather have, if you want to compare TQQQ with high implied volatility to a small, very risky cap, micro cap, small cap, also with very high implied volatility, I'd rather choose a leveraged NASDAQ ETF, which is based on, mega caps and large caps versus a small cap single stock. And if the single company goes out of business, you're out of business. This is just some graphs I got from the ProShares website. So again, TQQQ was formed in the bull market, so they don't have a lot of recessions to really give you a lot of data. But past performance is not indicative of future results, but it's a good way of getting an idea, but not necessarily going to tell you what the results are going to be. But you can see, in a bull market, TQQQ has done amazingly well. On the bottom chart, you can see the NASDAQ 100. Comparing that to ProShares, you can see that yield about 20%, 20.61% in 10 years, while TQQQ maybe after tax is 46.46%, which you'd say is not triple, it's maybe a little bit more than half, a little more than double return. Just out of curiosity, I was looking at the holdings of TQQQ, and I noticed that not everything is actually tech. I did notice about 31.4% is what I calculated contains U.S. Treasury bills for the reasons that I'm unsure about. Why long calls TQQQ versus owning it? So what's the difference between owning it and doing the TQQQ? If you own it, let's say you bought 100 shares of TQQQ at the price that I bought it at, which is $39 a share, that would be a $3,900 investment. Now, if TQQQ goes all the way down below the strike price of $18, but if you bought all 100 shares, you actually get to keep your underlying intrinsic value. But if you did what I do and just did the gamble of paying $2,500 for $18 call, if it goes below $18 at expiration, you pretty much lose all your extrinsic value, pretty much. So that is a risk that I'm taking. But I like it because options offer more control. I pay a fraction of the cost and I get to control 100 shares. I get to enjoy the growth of 100 shares. I have no idea which direction TQQQ is going to be going in the short term, but I have a strong bullish thesis that it's going to go up eventually. I hope you guys enjoyed. Again, I'm not a financial advisor. I'm just a dude on YouTube. I hope you guys enjoyed.